Hey everyone! Welcome back to the channel making investing less intimidating. Today we're cracking the code. We're diving into essential investment terms every beginner needs to know. So grab your notebooks, get comfy, and let's demystify investing together. Let's start with the basics. Stocks. Stocks are tiny pieces of ownership in giant companies. Buying a stock means owning a small stake in that company. If the company does well, its value and your stock increase. But there's always the risk the company might not do well. Let's move on to bonds. Instead of owning a piece of a company, you're lending money to a company or the government. Think of it like giving someone a loan, and they promise to pay you back with interest. Bonds are generally considered less risky than stocks but offer lower returns. Who doesn't love a little bonus? That's where dividends come in. Dividends are a thank you gift for investing, paid in cash or shares. Some investors love dividend stocks for their steady income. Let's talk about your portfolio. A portfolio is simply a collection of your investments. The key is diversification. Spreading money across different asset classes helps manage risk. If one investment isn't doing well, others can pick up the slack. Risk tolerance. This is a big one, folks. It means how much risk you're comfortable taking on with your investments. Higher potential return usually means higher risk, but it's crucial to invest in a way that aligns with your personal risk tolerance. Ever heard the saying, two heads are better than one? That's the idea behind mutual funds. Mutual funds pool money from many investors to buy a diversified mix of stocks, bonds, or other securities. Managed by professionals, they offer instant diversification and professional management. ETFs, or exchange-traded funds, are like mutual funds but traded on stock exchanges like stocks. This means you can buy and sell ETFs throughout the day, giving more flexibility. ETFs are also known for having lower fees than mutual funds. Bear market, buckle up for the downward slide. A bear market is the opposite of a bull market. It's when stock prices are falling or expected to fall. Bear markets are triggered by recessions, high inflation, or geopolitical uncertainty. It can be tough for investors, but opportunities can be found. Asset allocation is how you divide investments among different asset classes. The right allocation depends on your goals, time horizon, and risk tolerance. A good advisor can help determine the best strategy for your needs. Capital gains profit from selling an investment for more than you paid. There's also the flip side, capital losses selling for less than you paid. Understanding capital gains and losses is essential for investors, especially for taxes. Index funds are the superheroes of the investing world. They track the performance of a specific market index. Instead of picking individual stocks, you invest in the entire market with one low-cost investment. Index funds are a great way to build a diversified portfolio and aim for long-term growth. Dollar cost averaging is like putting your money on autopilot. It's a strategy where you invest a fixed amount at regular intervals, regardless of the market. This helps reduce market volatility and build wealth over time. Compound interest, the magical force that turns small, consistent investments into a substantial nest egg over time. It means you're earning interest on your initial investment and on any interest already added. The earlier you start investing and let compound interest work, the more impressive the results. Volatility. It's the word used to describe how quickly an asset's price can change. High volatility means a greater chance of big price swings, both up and down. Understanding volatility is crucial for managing risk and making informed investment decisions. Blue-chip stocks are the all-stars of the stock market. They represent large, stable companies with a history of reliable performance. Investors love blue-chip stocks for their lower risk and dividends. Growth stocks are all about potential. These are stocks of companies expected to grow above average. Growth companies reinvest profits back into the business to fuel expansion and innovation. Value stocks are like hidden gems, undervalued and have the potential to be worth more than you paid. Value investors look for companies with strong fundamentals but whose stock prices have been beaten down. They believe that over time the market will recognize the true value of these companies. REITs, or real estate investment trusts, are a way to invest in real estate without buying, managing, or financing properties yourself. REITs own or finance income-producing real estate, offering diversification and potential income. An asset class is a broad category of investments with similar characteristics and risk-return profiles. The main asset classes are stocks, bonds, real estate, and commodities. Understanding different asset classes and how they interact is essential for building a well-diversified portfolio. And there you have it, 20 essential investment terms, demystified. I hope this video has given you the confidence to start investing. Start small, do your research, and invest consistently to build wealth. If you found this video helpful, give it a thumbs up and subscribe. Until next time, keep learning, keep investing, and take care.